Welcome, everybody, to ICSC Las Vegas 2025. We are coming to you live from DLC's booth on the upper South Hall floor. I am really excited. I'm joined today for our first interview of the show by two people who are first and foremost friends. They are also two people who made career moves in the last year. So I'm joined today by Conor Lawler, who's the head of U.S. Retail Investments and Capital Markets in retail at Newmark. So welcome, Conor. First time.
Thanks, Adam. Pumped to be here.
And then I'm privileged to welcome back my friend Brandon Isner, who also in the last 12 months joined Newmark. little levity. I had to remind myself whether or not these two guys actually already knew each other or not, since it's pretty new since you guys came on board. But let's get started. We'll start with Brandon, who I think it's well known from your own stuff, has been on the road a lot lately, different parts of the U.S., traveling the world by alternative means of transportation.
Trying, yes.
So as we kick off ICSC 2025, give us the buzz at the intersection between the consumer and our industry.
So the things that I think about, this isn't original thought. You hear this all over the place, and some of the most important things are the unemployment rate and where salaries are going, and obviously inflation plays a big part of that. But we have this mix of all these soft indicators of a declining consumer sentiment, which is really fascinating to watch. But that said, unemployment is still relatively low. If you've looked at wage growth, wage growth has been above inflation for almost 2 years now. And so people are still have solid salaries, and the spending has continued. And so really, I get called out about this sometimes by some of my peers in other property types. Are retailers and consumers more concerned? It's like, no, actually, everything's kind of moving along pretty well. And there obviously there's some caveats with that, but for the most part, everything is still pretty strong.
So the first thank you of the show goes to Brandon for doing his homework, because you clearly read our white paper that we released on Friday. They talked about that separation between wage growth and the underlying inflation rate and what consumers, and I think in what consumers see as inflation they have to deal with when they go in the store. I think the other one is, this whole concept of hard data and soft data, right? Sales have been really actually quite dynamically to the upside. Everyone's trying to figure out, was that transference, was that pull forward, et cetera. But retail sales thus far this year are up 5.2% year over year. Right. We're obviously bullish as a result of that. I think Conor's going to tell me that means I should just pay more money for assets in a second. We'll come to that in 1 minute.
It's a great strategy, Ed.
Huh?
It's a great strategy.
It's a great strategy for me to be out of business. But seriously, just drill down for 30 seconds for the audience on the whole hard data versus soft data thing and how you're thinking about that.
Sure. So, obviously, yes, the consumer spending reports for April came out, retail sales, and up considerably, 5.2%. I think a lot of that had to do with, there's been some other talk about this too, about people nervous about the tariffs coming in and went out and bought a lot of hard goods, like, appliances, cars way up. But that said, one of the most interesting parts was food and beverage services were one of the top gainers, month over month. And so they're now up 7.8%. So I kind of joked around that everyone is complaining about having less spending power at restaurants. So it's tough to say that people are yes, that a lot of that buildup was buying up the hard goods, but people are still going out to eat. People are still going out to drink. And so again, that gets into the hard data a little bit. And I think it's up to us as professionals to really understand that it's not just about 5.2% above. It's like, well, where did gas prices go? Where did hard goods go?
So hold that thought, because Conor's going to want to take you to some meetings so that you can tell some of his clients about this. Let's shift over, Conor. That sentiment, that positive sentiment that Brandon opened us up with here, how is that impacting the capital markets in your view? Does that continue to be constructive to pull sort of capital that has not been in the space off the sidelines, or have tariffs sort of quieted the market a little bit in terms of that? We had seen a pretty good progression of capital coming off the sidelines.
Yep.
What are you seeing at the margin right here at the dawn of the show?
So I think, look, we've continued to see a tremendous amount of capital try to access retail as a product type. After years of sort of being lower on the totem pole in terms of investment priorities, notwithstanding the last tariff noise, we continue to see much of that capital wanting to find a way, an entry point into retail. Many of those investors have had a thesis in retail. They haven't been actually able to deploy into the sector. So while there's been a lot of talk about retail being a thematic investment, a lot of those bets actually haven't been placed yet. So we still see a tremendous amount of demand, bidding pools deep, as folks are trying to figure out what's the right play, what's the right sector, how do I actually align with the best operators to access the product type.
That's us.
We know a few. And so, we continue to see really good, robust interest. It's interesting if you look at, sort of the volatility of the last 60 days, for the most part, the market is saying we're actually right back where we were in February. So there's a fair amount of optimism, some of which is in the stats that Brandon and you just rattled off. But, the consumers is resilient. The job market is key, and people have jobs, and they may be changing their spending patterns, going a little bit more discount, maybe a little bit less luxury. But the spending is there, and ultimately retailers need space. And so the fundamentals are really what's pulling capital into the market.
Yeah, look, there's no question, right? As an operator for us, what drives conviction in the capital markets part of the business is strength and momentum from our retailer partners in the fundamental part of the business. The reality is there were almost no tenants who flinched in March and April and early May. There's been very, very little of that. And that gives us, and you've seen this with us, the conviction to continue to lean into the market to find the right opportunities where we can do something with the product that we're trying to acquire and are successfully acquiring as a way to satisfy the demand that those retailers are telling us they have. You mentioned capital that hasn't been in the space, coming either into the space for the first time or back into the space. What is it about the open air shopping center world and the product that's there? Is that about stability? Is that about upside? Is that what is driving investor decision making that is causing them to? I have a view about this, but you see a ton of data points here. So enlighten everybody a little bit.
It's interesting. We've transitioned as a product type to being a very downside protected investment. So because of the discount to replacement costs, because of the basis at which many assets are trading, gives you a lot of flexibility to ensure, even in a downside scenario, it's a good current return, it's a good positive IRR, it's a less risky investment than it's been viewed as in the past. Meanwhile, at the same time, because of the fundamentals, because of the demand, because when you get a box back, you have 2-3 tenants that you can force to compete against to get the best economics on your backfill, all of those things are leading towards more growth in our sector. So it's becoming a nice asymmetrical risk investment where downside is somewhat protected and upside is not necessarily capped. So we see
there are these things called tenant options.
And that's a fantastic point, Adam, because that's where we see the differentiation is assets that we call them unencumbered by leases or unencumbered by options. Those assets are seeing much more aggressive underwriting and terms and pricing. And so we find those opportunities to be really special. And the market is now appreciating that. So you'll see some prints, trades that are may look like the same on the surface. The asset, it's got the same lineup, it's got the same sort of profile trade area, but one may trade 75 basis points tighter because it doesn't have options. And I think that's a nuance that you don't necessarily see if you're just looking at cap rates.
No, I think that's right. I think that's an important point, and it's an important distinction in the market today. Let's talk a little bit about, and I think this applies to both of you, but Brandon, I'm going to start with you. Given the fact that there's a little noise around the consumer here, there's certainly noise, maybe we've sidestepped the tariff thing. Hopefully we have. But obviously the tariff thing, if to the extent it impacts the middle market, the middle income consumer, on the everyday goods front, how do you guys think about, the experiential retail that we're seeing in open air to increasing your rate? I'll start with you, Brandon, in terms of, can the consumer still afford that? How are you thinking about those brands, those uses, movies, kids, etc.? And then, Conor, just give you a second to think about it while Brandon's going to give us an answer here. But I mean, how do you see that impacting demand for assets when there are large, experiential components in assets? But let's start with how the consumer is faring for those uses.
I think it's still relatively strong. I mean, there are a lot of tenants out there that do this that are continuing to expand. They're not backing off.
Oh, yes. There's going to be a procession of pickleball operators a year later. I'm frightened.
Yeah, and I read recently Urban Air, they're reaching out. They've taken a lot of empty boxes that might have been tough to lease. They take big boxes it's great. They move in a little bit TI and turn it over. And there's not a lot of them around still. Like it's still not like they haven't really permeated the market. So there's still a lot of room for those operators to expand. And, again, going back to, it's not really a total experiential thing, but think about going back to those restaurant figures. Obviously people are still going out to eat. So, will they, maybe you can offer another thing while they go out to eat, like a Dave and Buster's or, some other activity. And I think it's great that they're seeking out open air centers because they're a little bit closer to the population. Now, you don't have to drive, like back in my day, to go to laser tag. You had to drive like 45 minutes. You don't have to drive 45 minutes to go to laser tag anymore. And I think that's good for everybody. But that said, your property type, it's still really tight. There's not a lot of space out there. So I think that it's just been interesting to see how some of those have come in. But look at you have veterinary clinics, like all kinds of other services that are coming in. Not just experiential, but the range of tenants that are seeking out retail space now. It's really fascinating. There's one more point. There's a REIT recently where I was on the call, and I forget which one, but they don't call their tenants retailers anymore. I forget the exact word, but there's such a wide range of uses. It's more of and the idea of occupiers of retail space rather than retailers. And I think experiential is part of that, and I think it still has a lot of room to grow.
Well, if the use case is widened out, right? I mean, Conor, we're midstream in a transaction where you're representing the seller, where I think the future of that asset is undeniably going to be more. It's already got some mixed use. It's got some experiential. Our business thesis is it becomes more that, not less, given the density in the market. But, the big experiential elephant in the room in a big open air shopping center trade remains the movie theater, if there is one. So why don't you speak to that a little bit for the audience?
Sure. I mean, I think from the investor standpoint, credit still does matter. You have to make significant investments in spaces to backfill, unique uses. So that is on the minds when we're going and working on assets that have theaters. But at the end of the day, it all boils down to performance. So a theater that's got a dedicated consumer base, that's doing good volumes, that has a reasonable health ratio, still is a great attraction.
Where's that line, that health ratio line? Somewhere in that health ratio line, right? Your pool of bidders must thin out. Where do you think it is today, and is that better than it was a year ago, et cetera?
So it's really difficult to pinpoint a specific line. What we tell people is health ratios change depending on the productivity of your tenant. So
sure,
a theater doing $12 million can afford more rent or a higher health ratio than one doing $5 million.
No question.
So, but certainly you've seen that 20% level sort of always be a benchmark in the sector. And I think the theater operators would tell you they'd love to be at 15, and I think a lot of landlords would say 25. So, ultimately, if you're stepping in and buying an asset, you want to make sure that that operator is healthy, that they're going to be there. If they don't make it from a corporate level, there's a reason for that theater to be there, and ultimately there are we have seen a good amount of, operators that are willing to take theater space, but they may do it on different terms and may need a capital infusion, and so that's going to be factored into underwriting.
Got it. We're sort of at this moment in time now, Brandon, where retailers need to put the bet on for holiday, right? You think the market in terms of sales performance as we look forward, call it 6-9 months, you think it remains as strong today, gets stronger? You got any concerns that it weakens?
The things that are coming through, and again, I'm not a full-blown economist, so I don't know all the answers to this, but I think that there are some supply chain issues or some supply chain concerns, let's say, and that's something that could kind of unearth you're having enough goods in the store for the holiday season, which that would then push sales. But I just keep going back to this story that. We had the pandemic, which was half a decade ago, by the way. We still talk about that, but that was so long ago.
I had no grandchildren at the start of the pandemic. I had 3 grandchildren, so I live it every day.
But some colleagues that were in other property types were kind of calling me out that I don't have more concern about supply chains and whatnot. But retail just figures it out. 2 weeks after the pandemic, grocery stores had completely revamped how they do business, and they were doing curbside by apps. I mean, that was invented within. It was kind of coming up, but they shifted all the business. Same thing with a lot of great QSRs. They had these backed up drive-throughs, and suddenly there's a person out there with an iPad. Hey, what's your order? I'll get it. It'll be ready for you. Don't worry, everything's cool. And now they're building out multiple drive-throughs. So that whole side of the business changed. And I've been reading some earnings calls from different retailers, and again there are some supply chain issues, but we'll switch it. It's not going to be easy, but we'll do it. And so I don't know. I just feel like things will be all right. Maybe that's just the optimist, but I just don't see any massive obstacles yet that retail hasn't already dealt with at some point or another.
I think that's a great point. Actually, I'm always preaching the resilience of the retailer, particularly in open air. It gives them more optionality of how they can adapt and play under certain conditions. One more for you, Conor. We're going to wrap it up. Much like the question for Brandon, is the market, and given where we're seeing in terms of interest rates, inflation, cap rates are going where from here? And bidder pool sizes are going where from here between now and the end of the year?
Really going to put me on the spot here.
Hell yes.
Look, I think that we've seen different product types, different segments within price different.
Totally fair point.
So I think what we're watching for is we are going to see more product. Transaction volume in the first quarter was up. We're going to have a little bit of a steady state second quarter.
It does feel like there's a lot of product coming to market, right?
There's going to be a lot of product in the market. And so, what we're going to see is that balance between that wave of capital that has said we want to be investing in the sector and the supply that's now going to be there to satisfy that. So how that ultimately balances from a pricing standpoint, I think everybody here at the show is looking for that feedback. And we probably don't know for the next 30 days.
Fair. That's totally fair. Totally fair. Guys, thanks for coming in, kicking off the show with us.
Thanks, Adam.
Thanks, Adam.